by the data economy team beforehand. So you can see that some of this one, Steve. The data centre sector has seen increased investment and obviously continuing M&A activity over the last 12 months or so. And so how are investors now approaching the sector as it moves into its next phase of maturity, if indeed you believe it's moving into the next phase of maturity?
I'll take no more than 30 minutes to answer this question. So it's actually very interesting, the last panel session, and indeed some of the points that Louise raised. I think in terms of the investors, it is moving into a new phase. We talk around sort of infrastructure funds now being very interested in the space, and indeed John touched on the long-term submarine cable exposure, linear submarine cable as clusters of data centers, and similarly the infrastructure funds are getting involved in that. I think that's interesting. I do think the underlying theme is that the cost of debt and the flexibility and the agility provided in debt type structures has got to continue to be developed in order to keep the equity on board. The equity has to see a return, otherwise it will invest in something else. And I think that's the intense pressure. I really don't believe that anything much gets built without an equity partner or an equity interest, somebody taking the ultimate, first jump risk. So in terms of building financial structures or debt structures or infra lending or whatever it is into a data center construction and pre-let and then let life cycle with opportunities to refinance throughout that process. I think that is the cleverness that we now have to build into it. It isn't like investing in real estate. I think data centers really are their own quite distinct vertical. And for me, that is they are improvements we have to make in the overall sort of financing sort of structure.
Yeah, I think just to add to that, coming from a infrastructure investment mindset, looking relatively new to the data center space, we found it challenging in terms of valuation, looking at the more brownfield and established operations when competing against certain strategics, for example. So it's really trying to work out what part of the value chain we are able to play in. So at this point in the maturity of the market, I think certainly our focus is more tended towards trying to find where the value is and coming to the conclusion that, and touching on the points that the panel previously mentioned around greenfield development and securing land power, which fits into that sort of infrastructure development mindset. So.
Actually, as a sort of newer entrant into the market, Giovanni, obviously we're seeing increased interest from a number of traditional infrastructure investors into the sector. Do you think, therefore, that data centres should be classed as an infrastructure investment class, or do you still regard data centres as more of a real estate subsector?
I heard it described the other day as a tweener asset class, somewhere between private equity, infrastructure, and real estate. And I think you can't regard it as a homogeneous asset class in the degrees of grade between all the sort of entities, projects, corporates in the space. I think if you look at and trying to aggregate different subsectors, if you're looking at a model whereby you're building on core, you're letting it on a lease basis, then if you're more real estate. If you are taking a certain amount of operational risk through SLA arrangements, then that's something more traditionally infrastructure investors are comfortable with. And then if you look at expanding vertically, if you're looking at private services as well, then it feels a bit more like private equity. I think fundamentally though, if you look at a cash flow profile of data centers, CapEx, high operating margins, long life assets, then fundamentally they're going to be attractive to infrastructure investors. Then if you overlay on that, and this is the way we think about it, if you have control or own sites that have high power availability in metro locations, or you're an interconnection hub, then you can build a strong story around the stickiness of the revenue and be able to categorise it more as an infrastructure investment. I don't think there's any black and white lines there, but degrees of grey, but certainly that's how we're trying to determine.
I think personally, so real estate, so we have this question a lot about whether or not it's real estate, and I often draw the line around service. I think one of the things that the real estate guys are quite used to with the large service element is a massive services agreement. There's an SLA, there's rebates to customers if you don't deliver on service. You need an operating fee. I think that's generally where the real estate guys get less comfortable going from. And I know it's not always the case anymore. You always get a 10-year lease in which basically you just take money from the tenant and have very little else to do. But there was still an element of that mindset, which I think contrasts with the service element that you see in the data center world. The fact that we're all invested in flexible office, and that's almost an arbitrage between a long lease and short memberships. But again, you see that element of service, which we're going to a sort of institutionally provided flexible office. It's a service element that the real estate guys like to struggle with.
And I would probably throw a little bit in the mix coming from the diversified infrastructure background. The way we look at infrastructure, it's about minimizing price and volume risk. And in data centers, I think in terms of volume, has a very strong underpinning, undoubted, which I think prompts a lot of interest in the asset class. I think pricing is probably less of a clear-cut case, and there has been discussions of the operators, kind of how is it a symbiotic relationship. But I mean that's where it could go towards infrastructure when you either get this through a contract or through certain barriers to entry or through competitive mode, irreplaceability, difficulty to move things around. But equally, I think that's where the risks are lying and where every investor needs to make up their mind. Are they comfortable with a hyperscaler, been a very sophisticated counterparty and been able to move maybe 5 years, maybe 10 years? Is an investor comfortable around the technological developments? Is an investor comfortable around building the revenue stack if we start kind of adding services on top of that? And that's then where the differences between private equity and infrastructure might play out.
And taking that point about additional services, to what extent do you think about data centers in the context of broader telecom infrastructure investments? Do you think we'll see increased specialization or more convergence in terms of business models? Connectivity providers moving into the data center space, or data center providers moving into IT service space.
And we do see a lot of convergence, to be honest. So I think, again, looking at connectivity providers, wholesale connectivity providers, which would be the traditional domain of infrastructure investors, so subsea cables, long distance fiber, metro fiber for that matter, you look at what the companies are doing, and they do buy data center operators or data center assets. So they are moving into the space. And then I think the whole discussion around edge, around colo with enterprise, small end of the wholesale, colo, that all hinges upon services which can be provided. And so we see some of the winning business models which attract a lot of interest from the infrastructure investors trying to catch this balance between long-term contracts, then maybe connectivity and interconnectivity within the data centers, creating the ecosystem, and by that matter diversifying your customer risk rather than being dependent on a single thing. And for us, in terms of philosophy of an infrastructure investor, we like investing in businesses. And so once you move into the services, it is very much about business. It is about the ability to drive sales, drive operations, affect geographical expansion. And even though these are maybe newer things for an infrastructure fund manager, we do like that. We believe that that's where the value can be created and where we can continue delivering the type of returns our underlying investors are seeking.
Yeah, I mean, I agree with Dmitriy. I think there are obvious overlaps in the metro, submarine, and data center spaces. And I don't really mean around sort of synergies in organisations and delivery, but it's more sort of types of service and product to sell to single clients. You can reach across bigger geographical areas, and you can service clients better with more of those products that you about. And as you know, the whole somewhat prickly subject of edge data centers and edge solutions coming over the horizon, I think it's going to be an easier segue into that as well. So I'm surprised actually there hasn't been more integration in that space, but I think it is now the next sort of few years very, very ripe for that. They're already, and actually I think a good sign for it is that all of the conferences out there around the world that were once strictly metro or strictly submarine or strictly data center or managed services, they really are now all totally cross vertical type events, and I think you can see that move effortlessly between those various businesses from a career standpoint.
So seeing that with DC moving more towards edge, but also do you see the same level happening with 5G, and if so, what do you think the implications are going to be for investors, in particular in regards to predicted levels of contracted cash flow on those types of investments?
So, the very eminent previous panel grappled with edge, but I'm not going to let my comparative ignorance stop me from sticking a definition in there. I just see it really as the low latency, high bandwidth requirements that we put for that compute storage near the edge. And when you look at the sort of applications, the typical ones that always come up are autonomous vehicles, or remote health care, or Industry 4.0 and Internet of Things. And what strikes me about many of those potential use cases, the question is how soon they're coming. What strikes me about them is that many of those organisations are already procuring data center space, so they're familiar with MSAs and procuring with those service requirements. So there's a sort of superficial similarity there, but of course they're going to be procuring X megawatts across multiple locations, and it's going to be for the providers to kind of work out the orchestration of that. And I think that again, that's another software element that's going to be a bit different than the real estate approach to be taken in the past. So some of the use cases I've also seen seem to centre around upticks in usage around Stadia, for example, the Stadium goes to the Google game streaming platform, or sort of surges because of things like Pokemon Go. So I also think the notion of selling at X pounds per kilowatt could be eroded by that, and you'll have to have a bit more dynamic pricing. It's I think it's going to be a little bit defined by who ends up owning this space, because at the moment I see a lot of this edge going to telcos. Interestingly, they may likely sold off their data centres, but maybe they'll end up owning it. Maybe it will be the cloud providers who will be very vertically integrated and move into that space, or maybe there'll be a new opportunity for the multi-tenant data centres to move into that edge as well. So still kind of all to play for. And I think one of the challenges is whether the big infrastructure funders will get comfortable funding some kind of 5G or edge rollout when there's not really a use case. But most of those use cases, the really big ones, require you to have a pretty well deployed infrastructure before they're viable, like autonomous vehicles. So you're trapped in that vicious circle.
Yeah, I think I don't have the answer to this as to how we deploy it, but certainly as an investor in fibre networks, sort of questioning how that business model can be virtually integrated backwards, where they're using their space in the pops, where ISPs are storing their information within those to actually supply their customers on that side as well. So we haven't seen the right model yet, but certainly something that we're thinking about when we're looking at these investments.
You'll notice that there's going to be a fifth panel member. So this question is in. He had to rush off to buy one of the following. So general question for the panel: what, from each of your perspectives, looks currently the most attractive? Greenfield developments, acquiring older sites, or maybe acquiring a mature operator?
I have quite a strong preference for development. I've seen a number of opportunities around the older sites, and I'm not entirely sure how the refurbishment or end of life gets modelled. It seems to me that with many data centres built in North East, we're kind of coming up to the period now of major refurbishments. So when I look at an old data centre or buying fully developed assets, particularly if they're more mature and stabilised, I would struggle with the cost of ultimately having to refurbish them, which could only now be 5-7 years away. Whereas I look at the development element and I look at the way that data centres have become simpler with indirect air and mechanical cooling, and construction has become more straightforward. I also look at, from our perspective, the returns perspective, talking about returns to equity, the returns profile of development still looks comparatively attractive by mature operators. So that's a slightly different avenue.
I think that I've looked at a couple of quite decent opportunities recently, which are substantial sale and leaseback type deals, and I agree. Data centers built out there in 2000 and 2002. I was there in 2002, but they now have not particularly stood the test of time. We didn't know what we needed 20 years on. I think data centers constructed in the 2011, 12, 13, that kind of time period, they're generally pretty well built, and I think that there is just in terms of return on capital type thoughts. I think there are businesses out there in the media space or in the hyperscale space who found themselves owning substantial amounts of data center real estate are probably going to question the board meeting what's the return on these big lumps of real estate when we're really 18, 90, 20% return on the money, why are we seeing 7% return on real estate? So I think there are some interesting opportunities in just the whole sale and lease back and then some partial redevelopment or trying to sell more of that space in growing markets.
So if you're a globally ambitious data center development operator, or investor in one of those, given the sort of site availability, planning and power constraints that we're seeing, particularly in some European markets, do you think that those data center operators are going to need to push that in order to increase footprint?
I think there's an obvious need for this power and land availability, and so there's a need to, I think, pivot towards, for want of a better word, land grab and power grab in the market just to future-proof businesses. I think that's coming back to the question about how we look at the space. I mean, certainly that's where we are focused on in terms of the opportunity set. We've heard what Matt said about where we see the real value being created in the space. I think the other element that we're also looking at quite heavily, we're as a platform, one of the largest renewables developers globally, and seeing how we can co-locate data centers with our renewables platform to offer more cost-effective power solutions. So I think that's going to be sort of front and centre of minds as we move away from the history of diesel generators and look at battery storage and the like as well.
I would say in terms of, from our perspective, what we like is relatively conceptually simple, difficult to find. So, we would like to have some existing operations with a small proof of concept, ability to expand, presence in several markets. That's to start with, right? And then, we can grow it from there, and we love it, and it's all great. What's the issue? The issue, there are no targets. If there are targets, they're bought by strategics. Actually thinking the last 2-3 years, should we have bought the targets we strategic bought and bid, a little bit more? And the answer is probably yes. Are there enough, targets of that category thinking in European context? It kind of a little bit challenges my creativity. So then it comes to the question, should we move to another markets and how do we combine the two? But again, I think I would be careful to move into land grab territory. That's probably a little stretched too far for us as an infra investor. I think there is value to be created there. There are people who are proficient there, and development at some point is at the core of infrastructure investing, but it's a little bit of combination of those, and then you know, where do we make compromises? Is it, you know, 3 markets, 2 market, maybe 1 use case, kind of how big and how much proof of concept we need before we get investing. But certainly from the valuation standpoint, if it's all kind of done and developed and visible, then it's very difficult to compete and achieve any significant returns.
So Steve, do you think we'll see new entrants into the market in the way that we have over the last 10 years or so, or do you think the capital barriers are now too high for those guys?
No, I think we will, and albeit the capital barriers are high, you know, the financing world of equity and debt and infrastructure funding, whatever, will take shape around the clearer about what we need, what is sort of space. And I think that somebody mentioned in the earlier panel the downward pressure on price, a great deal from the hyperscalers, I think has been, we'd argue it's good for the industry, and it sort of, but it gets down to an affordable price, but affordable to build and to run and to operate and to see a return out of as well. So I think we will see, you know, new entrants as we go on, because it's in such extraordinary growth.
Yeah, and certainly from our side, we're interested in trying to back those new entrants. You know, some of these management teams that come out of the major players do have local insight and understanding of the local market dynamics. So we do see opportunities in that space, and we are keen to back those management teams to start potentially in the space as well.
I mean, I think the barriers to entry are really hard. I mean, it's seriously hard to launch a new operator in that middle part of the market. I think that it's one of the only panel I think I made this point that Edge provides a lot of opportunity, build to suit potentially as well, because there's a lot of optimisation of capital there. I think it's essentially as the available capital matures and looks for more EBITDA positive opportunities, it's a little bit harder to put some things in the market and scale from there. I don't think we see that many new entrants.
Yeah, I suppose it's balancing retail against a better understanding of the risks associated with data centre investment from equity or debt. We can't have a panel session without mentioning the H word. And so, do you think significant hyperscale concentration in a data centre would you regard that as a positive or a negative?
I think the previous panel probably covered off the points and obviously talk with far more authority than I do, but certainly from an investment perspective, obviously massive positive in terms of demand and uptake and top line revenue growth comes with risks, whether it be through, let's say, contractual arrangements and we built a suit model, what kind of risks in terms of LDs are you taking as a data center owner, operator, investor? Obviously, we touched on it before, pricing compression, and where does that fall to? And I think from our perspective, I mean, one of the key things we're considering from an infrastructure investor mindset is what is the relevance or the use of that site over the medium term? Is that having concentration introduces binary risk into that specific data center? So just understanding will this site be relevant in 5, 10, 15 years time from power availability, scalability, and potentially renewables perspective?
I'm conscious I've been hogging all the questions, so I've got 5 or so minutes left. Are there any questions from the audience? Okay.
So I'm particularly interested in the edge stuff that we've all been skirting around, I guess. But for me, the edge market won't really take off until it's been a massive network upgrade. That's true in the UK, it's probably true in most of the world. That to me is the biggest investment required. Are you looking into that, or is anyone driving you towards investing in the backhaul networks?
I mean, certainly a massive focus of our business. We focus on both terrestrial fibre and data centres. We see there needs to be a massive amount of upgrade investment in the space, so it is a big focus for us, and we see that facilitating opportunities within the edge space and trying to integrate those various sides.
Who's driving that right now then?
I think it's the constraint is not necessarily capital. I think the constraint is just trying to get things done in the actual scale of what needs to be done, particularly from a terrestrial fibre perspective. In the UK,
it's rather a bunch of government programs and statements, right, which can be positive or negative on the sector. We see that telecom incumbents kind of actively participating in that, and there are spin-outs of networks and joint ventures in that sense. And basically the race in our mind, if we look back 20, 25 years, then there is a little bit of fear of overbuild in our minds, and it's kind of a hard thing, if you come to the industry as it stands today with the growth it has and with the volume it has, then it's a little bit hard discussion, but that's still on top of our minds. And then the big question, which makes it quite tricky, is that kind of the thesis is very clear. The exact roadmap is very unclear. I mean, it's actually up to the point where I've been talking to some execs in the telco industry, and they say, oh, actually our software to test 5G deployment is not perfect enough. We cannot test it properly. So we are talking, okay, which network do we build and small cells, and where do we put the the edge data centers? And the users tell us, actually, we don't know if that works and how it works as it stands today. So it's a very dynamic thing, but for sure, kind of, if you would ask, from the infrastructure capital standpoint, where is the deal flow? How did it change over the last 10 years? Massively towards telecom infrastructure. So I would say it's 40% is energy, 40% is telecom, and 20% everything else. And kind of 12 years ago, it would be Thames Water, kind of in the center of mind, and that pivoted massively.
Time for one more question from the audience.
Yeah. What kinds of conversations go on within your corridors when you see the feeding frenzy that's around kind of medium-sized portfolios of stabilised assets coming to the market, coming to mature markets for sale, and you see the kinds of multiples that are being commanded in those transactions?
I think in our case, taking that to the development point, having coming from a real estate development perspective, we look at that and often think that is what works better for our residents is to develop ourselves, build the management teams, build the businesses. Now there are that's very difficult to do in the flat markets, just of course to size, but there's plenty of other interesting opportunities if you move into tier 2 markets or you move more into the edge space. So I think for our type of capital, which is not a huge infrastructure capital, that's very much
Paul, do you mean like the recent acquisition of Interaction, for example?
Yeah, that's hard around that.
We should say that. So,
but it's not the biggest multiple.
No, but truthfully, so you look at that business there, which has been around for quite a long time. I think they, in that time period, they've done some brilliant things actually in terms of how they've developed products and proximity ideas, and how they developed quite a substantial footprint of data centers. They've also got some really key type assets down in Marseille and places like that, which really managed to capitalize on all the big east-west cables and things like that. In terms of how that was valued and acquired, I haven't seen all the breakdown of that and how the SEC can go through the rinse through of what has to be let go and otherwise something like that. And I think that in the next few months we get to have a good hard look at that. But I don't think I came away from thinking that was a shockingly overvalued in terms of we're not into crazy number territory, and it's a very well established long-term business. But I do think actually it goes back to the earlier question in terms of consolidation and general acquisition out there, and you know, our independents out there building 2, 3, 4, 5, 6 data centres, making them more shiny, selling them up into a Digital Realty or a Cyrus One or any of those guys. I think that'll continue because there are some very, very good, you know, operators that can, and guys who are good in that construction space that can raise 4, 5, 6, 700 million, build a decent business, sell it for $1 billion, and I think that at that level we'll continue to see that. Exactly how, with hindsight, you look at the valuation of that particular transaction, which I don't think anyone, I certainly wasn't expecting. It was a surprise when it came through on the people should you well over that. But I didn't see that one coming. But yeah, I think it'll come out looking, you know, normal.
The question which comes up is basically, you know, whose pie is getting eaten into? Because, you know, I come to this point all the time, but volume, incredible, you know, we are, from the user perspective, and broader connectivity, it's a declining market. The revenues of the telecom operators are declining. So, you know, you need to get yourself to believe this is, you know, the right sector and the right player in the market. And if we come to invest here for 15, 20 years, then it will be the same. And again, once you start comparing kind of revenue projections or historicals for that matter versus volumes, it's a very different picture. I mean, there are segments of the market which are in single digit, kind of mid to high single digit growth territory, which is not bad, kind of in the generally, you know, more stagnating GDP environment. But it's not 30%, and so that's where I personally struggle, kind of when it goes into, you know, 20 and 30s territory, which has some of those assets fetched, and how does it tie together to the dollars which are actually get spent in the sector?
Thank you. I think we'll draw to a close there. I just want to thank all of our panellists here.